Well, so we've seen a rebound in energy prices to a certain degree. We've seen a rebound in housing prices. So when you look at the Case-Shiller index, for example, house prices were correcting. Now they've kind of stabilized. They've gone back up in aggregate. And overall, I think that's kind of the trend we're in now, in the sense that we've had a permanent boost in terms of how much money's in the system. Even as the Fed tries to draw down their balance sheet, there's still money coming in from the reverse repo facility.
Right.
So it's kind of balanced at the current time. I think, around the margins, I kind of see us selling here for a period of time because there's still downward pressure on a number of industries from these rate hikes.
Financial expert Lyn Alden dives deep into the complex world of economic trends and government policies. Alden analyzes the recent rebound in energy and housing prices, emphasizing the delicate balance the economy currently maintains. She highlights the unprecedented influence of fiscal deficits in fueling inflation, a departure from traditional banking sector driven cycles. Alden discusses the challenges posed by rising interest rates, particularly the impact on existing debt and the continuous increase in interest expenses. With a sharp focus on the bond market, she unveils the mechanical issues arising from limited buyers and surplus supply. As she delves into potential investment strategies, Alden's insights are both enlightening and cautionary. Stay tuned as she unveils an unexpected twist in the bond market's narrative, revealing the hidden complexities that might shape our financial future.
But part of what's fueling the inflation is the very large fiscal deficits. And what makes this kind of different from other cycles, at least up to a point, is that most of the money supply growth did not come from the banking sector. It did not come from credit creation. It came from large fiscal deficits. And we have very high public debt levels now. And so the challenge is, the whole process of raising rates is meant to slow down bank lending. It's meant to slow down kind of the main driver
Right.
of that money creation, which in the 70s worked because you had low public debt, you had very high demographic driven bank lending. But in this era and back in the 1940s, most of the money creation is from those fiscal deficits. And so the problem is when you raise rates, you actually increase deficits. We have 100%, over 100% debt to GDP. If you raise rates, that actually pours more money into the economy. And so I think they're kind of in this kind of like balancing act here where it's going to be hard to fully land the plane. So in the next 6 to 12 months, even if rates just stay where they are, so if they stop going higher but they just stay where they are, that interest expense is still going to go up a lot because there's still existing debt that keeps maturing at those higher rates.
Right.
And so even Treasury notes issued a year ago, for example, when they get refinanced at this current rate, they go up substantially. Any longer duration bond, like a 5 year, 10 year, a 30 year, anytime they mature and get reissued, it goes up. And so, if you run the numbers, we get up to something like 1.7 trillion on interest expense annually if you just hold rates where they are and have the full weighted average eventually catch up to that. Now, we wouldn't get that in the next couple quarters, but basically, we continue to add tens or hundreds of billions of dollars in interest expense to the existing deficit at the current time. So I do think that we're going to continue to see very high bond issuance and continue to see extremely high and still rising interest expense, which is part of the deficit and is a source of money that is flowing out into the economy. I do. I'd be a little bit hesitant to say push the shorts here. I mean, we already had a very large down move in bonds. I've been a bond bear for years. I mean, the speed of this move even was kind of surprising to me, even as a bond bear. Um, and so the real rates are starting to get interesting. I can see, for example, why someone would want to go long tips here. You get a
Mhm.
decent real yield on your position. The problem is not that at this point, I think they're appropriately priced. But the challenge is there's just too much supply relative to demand. Basically, the types of buyers that are not so there's a couple main pools of buyers for treasuries. They could be the foreign sector, but they're not buying because the dollar index is strong. So they're in currency defense mode. They're not rapidly accumulating reserves. There's the Fed, but they're not buying. They're actually net selling by letting bonds mature off their balance sheet. There's banks, which were big buyers recently, but over the past year, that's reversed now. So banks are no longer buyers, and so that leaves only domestic non-bank entities. So insurance companies, asset managers, households, you and me, we're the kind of the only buyers left, and we're generally when we buy bonds, we don't buy them on leverage in the way that these like money creators can,
Hmm.
and so there's really only so much that can be absorbed, and so it's more of a mechanical issue than investors assessing them and saying that they're inappropriately priced. Um, and I think that's the challenge right now. And
Right.
so I do see ongoing problems that continue to occur. We could pause here. Bonds could get a little bit of a bid after such an oversold condition. But the risk reward is still relatively unattractive when you can hold T-bills, for example.
Yeah.
And to the extent that I would get duration, I think tips are interesting, but the whole bond complex is just it's still a mess.
In this next important segment, Lyn Alden highlights the challenges in making multi-month predictions due to unpredictable market factors. She suggests that risk assets, including Bitcoin, are likely to remain range-bound as new liquidity entering the market is limited, and major crashes seem less probable. Alden explains Bitcoin's historical price correlation with global broad money denominated in dollars, emphasizing its sensitivity to factors like central bank policies, credit creation, and dollar strength. She distinguishes Bitcoin's correlation with monetary inflation from traditional CPI inflation. Alden notes that Bitcoin's supply side has tightened during the bear market, but the key to its next surge lies in the rise of global M2, which he does not foresee in the immediate future. The market, according to Alden, is akin to a coiled spring, with limited liquidity and strong-handed holders. While Bitcoin's price could fluctuate between 20,000 and over 30,000, a significant upward movement would likely require a substantial increase in global M2. Stay tuned for Alden's expert insights on market dynamics and potential catalysts for Bitcoin's future growth.
So, I mean, any sort of multi-month prediction's challenging. There's all sorts of things that can happen, but in general, I view a lot of risk assets, including Bitcoin, as probably being kind of range bound during that time period. I don't see a lot of new liquidity coming to market, but I also don't see a high likelihood of major crashes. But I mean, if you get a liquidity problem in the bond market, that's where you could get a pretty severe drop in some of these risk
Right.
assets. When you look at Bitcoin price action historically, um, this won't tell you anything on a day-to-day basis, but on like a longer term basis, the major correlate it has is with global broad money in dollar denominated terms. So if you look at global M2, what is the total value of it denominated in dollars? And is that, the rate of change, right? So what does the year-over-year figure of that look like? Bitcoin tends to be highly correlated with that. So basically,
Mm.
it's a way of saying that Bitcoin is correlated with monetary inflation, which is different than and precedes CPI inflation. And so during periods of rise in liquidity, either because central banks around the world are printing, or banks are making a lot of credit, or the dollar's weakening, because that's the denominator for global M2 in dollar terms. When any of those major factors are kind of prevailing, Bitcoin is usually doing quite well. And when the majority of those factors are contracting, and global M2 is flat or down, that tends to put negative pressure on Bitcoin, and or so at least that's the demand side. So the way I would
Yeah.
describe it is that over the course of this bear market, the supply side is tightened in the sense that fast money from the prior bull market has largely been washed out. A lot of coins have gravitated towards strong hands, people that are just dollar cost averaging in, hodlers. That's kind of a pattern we see in bear markets. And so there's like basically a coiled spring there. There's not a lot of liquidity for buyers that want to come in. I mean, there's just not a lot of coins kind of ready to leave hands. But then the question becomes, what sparks the next wave of demand? And I
Right.
think it will likely be the next rise in global M2. And I don't really see that as likely in, say, the next 1 quarter, 2 quarters. That doesn't mean you can't fluctuate. I mean, you could go anywhere but up over 30,000. You could go retest 20,000. I don't really have a firm view on that level of range, but I think until it would probably to see a bigger move, we'd have to see a pretty significant move in global M2.
Thank you for tuning in to this eye-opening analysis. We hope you found this discussion insightful and thought-provoking. Remember, understanding the complexities of the financial landscape is crucial in making informed decisions about your investments. If you appreciated the insights shared in this video, don't forget to hit the like button, subscribe to our channel, and click on the notification bell so you never miss an update. Share your thoughts and questions in the comments below. We love hearing from our viewers. Stay informed, stay vigilant, and most importantly, stay ahead in your financial journey. Until next time, take care and invest wisely.